Hello, everyone. Today we are tackling a topic that keeps many Australian parents awake at night. It's the ultimate kitchen table conversation. How do we pass our hard-earned wealth to our children without the tax office taking a massive cut and without ruining our kids' lives? If you're listening to this, chances are you've worked hard. You've ridden the wave of the Australian property market. You've built equity. And naturally, you look at the skyrocketing housing prices in Sydney, Melbourne, or Brisbane, and you worry. You think, how will my child ever afford a home without my help? So the instinct is to give, to transfer, to help. But, and this is a huge but, I've seen too many families act out of love, only to end up in a legal or financial nightmare. I'm talking about unnecessary tax bills in the hundreds of thousands or family fortunes lost to a child's divorce. Today, we're going to break down the 4 specific methods of transferring wealth and property to your children in Australia. We're going to look at the cash gift, the property transfer, the traditional inheritance, and finally, the strategy used by the ultra-wealthy, the family trust. We aren't just translating the rules. We are deep diving into the strategy. So, grab a coffee, maybe a notepad, and let's get into it. Part 1. The cash gift. Let's start with the most common method. Method number 1. The cash gift. This is usually how it starts. Your son or daughter graduates, maybe find a partner and wants to buy their first home. But a 20% deposit in a decent suburb is now $200,000 or more. So you write a check, or you transfer the funds. The pros, it's simple, it's fast. And here's the good news. In Australia, generally speaking, there is no gift tax. If you have tax-paid cash sitting in your offset account and you give it to your child, the ATO doesn't usually demand a cut of that specific transaction. The cons, hidden dangers. However, the source material warns us, and I cannot stress this enough. This simplicity is deceptive. Once you transfer that money, legal ownership shifts, is no longer yours. Scenario A. The divorce trap. Imagine you give your daughter $300,000 to buy a home with her husband. 5 years later, the marriage falls apart. In the eyes of the family court, that house is the matrimonial asset pool. That $300,000 you thought was a family legacy? It's now up for division. Your daughter's ex-husband could walk away with half of your hard-earned money. I've seen parents watching from the sidelines, absolutely helpless, as their retirement savings, which they thought they were storing in their child's house, are legally stripped away. Scenario B. The spendthrift child. What if your child isn't ready for that wealth? You give them a lump sum, and instead of a deposit, it becomes a luxury car, a holiday, or bad investments. If they go bankrupt, that money is gone. It's seized by creditors. Scenario C. The pension trap here is something the source text touched on that we need to expand. If you're approaching retirement age and planning to rely on the age pension from Centrelink, you have to be careful. You cannot just give away assets to qualify for the pension. Australia has gifting rules. If you gift more than the allowable limit, currently $10,000 in one financial year or $30,000 over 5 years, Centrelink will still count that money as your asset for 5 years. You could leave yourself with no cash and no pension. The fix, loan, don't gift. So how do we solve this? The smart way to do method 1 is not a gift, but a loan. You don't just hand over the money. You sign a formal loan agreement. A lawyer should draft this. Crucial detail. To be taken seriously by a court, the loan usually needs to have commercial terms. It needs an interest rate, even if it's low, and there should be occasional repayments. Why? If your child gets divorced, you can put your hand up and say, wait a minute, that $300,000 wasn't a gift. It was a debt. The couple owes me that money. That debt gets subtracted from the asset pool before the husband gets a cent. It sounds unromantic to sign a contract with your kids, but it's the best form of insurance you can buy. Part 2. Transferring property while you are alive. All right, moving on to method number 2. You have an investment property. Maybe you bought it 10 years ago. You don't want to sell it. You just want to change the name on the title deed to your child's name. The myth. I hear this all the time. I'll just sell it to my son for $1. Or maybe for $200,000, way below market value. That way, I don't pay tax, and he doesn't pay stamp duty. The reality check. Stop right there. This is the fastest way to trigger an audit. The Australian Tax Office and the State Revenue Office are not stupid. The market value substitution rule. When you transfer an asset to a related party, like a child, the law treats the transaction as if it happened at full market value. If the house is worth $1 million, but you sell it to your kid for $200,000, stamp duty. The state government charges your child stamp duty on $1 million. Capital gains tax. The federal government charges you CGT as if you sold it for $1 million. So, you have a massive tax bill, your child has a massive stamp duty bill, and no actual cash change hands to pay for it. It is a cash flow disaster. The loan serviceability issue. Also, does the property have a mortgage? You can't just transfer a debt to your child. The bank needs to assess their income. If your child is a student or on a low income, the bank won't let them take over the mortgage. You're stuck. Is it ever a good idea? Occasionally. If you anticipate the property value is going to explode in the next 10 years, taking the tax hit now might be cheaper than paying it later. But generally, transferring property explicitly while you are alive is the most tax-inefficient way to pass on wealth. Part 3. The traditional inheritance. Now, let's look at method number 3. This is the I'll deal with it when I'm dead strategy. You hold the assets until you pass away, and then they go to your children. The tool. The will. This relies entirely on your last will and testament. Now, here is a scary statistic. About 50% of Australians do not have a valid will. If you die without a will, the government writes one for you based on a rigid formula. In most states, the first beneficiary is the spouse. If you have a blended family, say a second wife and children from first marriage, it gets incredibly messy. The assets might go to your new partner, and your children from the first marriage could end up with nothing. The joint tenant trap. This is a technical point that catches so many people out. When you buy property with your spouse, you usually buy it as joint tenants. This means you both own 100% of the property together. The rule of survivorship. If you die, your share automatically goes to the surviving owner. It does not go into your will. The problem. Let's say you have a terminal illness. You write a will saying, I want my half of the house to go to my daughter. But if the title deed says joint tenants, your will is ignored. The house goes to your spouse. If you want your will to control your share, you must change the title to tenants in common. This allows you to own a distinct share, for example, 50%, that you can leave to whoever you want. The testamentary trust, the super will. Now, if you want to be sophisticated with method 3, you don't just leave the asset to your child directly. You leave it to a testamentary trust. This is a trust created by your will. Benefit 1. Protection. The child doesn't own the house. The trust does. If the child gets divorced or sued, the house is much harder to attack. Benefit 2. The tax hack. This is huge. In a normal family trust, if you distribute money to minors under 18 years old, they get taxed at penalty rates, around 45% or higher on anything over roughly $416. But in a testamentary trust, minors are taxed at adult rates. This means you can distribute about $18,000 tax-free to each grandchild every year to pay for school fees. It's a massive tax saving that is unique to inheritance. Part 4. The billionaire strategy, the family trust. Finally, we arrive at method number 4. The source material calls this the rich man's method, but honestly, it's for anyone serious about asset protection. This is the discretionary family trust set up while you are alive. How it works. Instead of buying that investment property in your name or your wife's name, you set up a structure. The trustee, usually a company that legally owns the asset. The appointer, this is the God mode role. This is you. You can hire and fire the trustee. The beneficiaries, you, your spouse, your kids, your grandkids, a related company. The magic of control versus ownership. As the saying goes, own nothing, control everything. Because you don't personally own the house, if you get sued, the house is safe. But the real magic happens when you pass away. The tax-free inheritance. Unlike method 2, transferring property, which triggered stamp duty and CGT, or method 3, which requires probate, the family trust is seamless. When you die, the property doesn't move. The trust still owns it. All that changes is the appointer, the person in control. In your will, you pass the control of the trust to your reliable child. No stamp duty. No capital gains tax triggered. The asset sits there undisturbed. The rental income just starts flowing to the next generation. The caveats, of course, it's not free. Setup costs. You have to pay to set it up to lawyers and accountants. Land tax. In states like NSW and Victoria, trusts often don't get the tax-free land tax threshold. You pay land tax from $1. You need to do the math to see if the asset protection is worth the extra annual tax. The 80 or 99-year rule. Trusts can't live forever. In most states, except South Australia recently, a trust must close down after 80 years. But that is enough time for 3 generations of wealth building. Deep dive, the emotional component. We've covered the technical 4 methods, but I want to circle back to something the original text mentioned, which I think is the most profound point. Wealth without wisdom is a disaster. You can have the perfect family trust structure. You can have the best lawyers. But if your child is not educated on how to manage money, or if your relationship with them is transactional, it will fail. There's a concept in wealth management called affluenza, where children who inherit too much too soon lose their drive. They lose their ambition. The text mentioned that giving assets too early can lead to King Lear situations, where parents give everything away and then are abandoned by their children. It's a dark thought, but a real one. Recommendations. Educate first. Before you transfer a cent, transfer knowledge. Teach them about leverage, about tax, about hard work. Staggered access. If you use a trust, you can set rules. My son becomes a co-director at 25, gets full control at 35. You don't have to hand over the keys the day you die. The sleep at night factor. If a complex structure stresses you out, don't do it. A simple will is better than a trust you don't understand. Conclusion and next steps. So, let's summarize the 4 paths to property legacy. Cash gift, easy but risky. Use a loan agreement. Direct property transfer, expensive because of tax and duty. Generally avoid unless specific strategic reasons exist. Inheritance using will, the default. Check your joint tenancy versus tenants in common status, and consider a testamentary trust for tax breaks. Family trust, the gold standard for asset protection and seamless transition, but comes with higher maintenance costs and land tax issues. What should you do right now? If you own property and you have kids, here is your homework for this week. Check your title deeds. Are you joint tenants or tenants in common? Does that align with your wishes? Review your superannuation binding nomination. We didn't even touch on super today, but remember, super doesn't automatically go through your will either. You need a binding nomination. Talk to a professional. I am a podcast host, not your lawyer. The laws in Australia change. The rules in Victoria are different from Queensland. You need a customized plan. Your legacy is about more than just bricks and mortar. It's about the peace of mind that comes from knowing that whatever happens, divorce, bankruptcy, or death, the fruit of your labor will protect the people you love. Thank you for listening. If you found this helpful, share it with your partner or your parents. It might be the most valuable conversation you have this year. I'll see you in the next episode.